our last chapter, I believe, is on international trade. So this chapter, this particular chapter, this is an easy one. This is going to be a quick lecture. There's nothing complicated here. What this does is it gives you the terminology that you need and sort of a little bit of background on our monetary system, on our banking system, so that when we roll into the next two chapters, which I believe Thursday it's on our banking system, and then on Tuesday is going to be on monetary theory and policy. It's going to give you the vocabulary that you need to be able to understand what we're talking about, and a little bit of background on this whole banking thing and how it started. And this is more of a historical look at money in the banking system, but there's some good stuff here, and I'll really point out what facts and figures I think you should focus on for the final. Hang on a second. Okay, did everybody see my PowerPoint change? Will somebody give me a thumbs up or? Okay, great. Okay, so the first thing that we need to talk about is, like, what did we do before money? What was the situation? How did we evolve to using money as a standard for exchange? And we can't start talking about money and exchange without talking about the very first forms of exchange, pre-money, if you will. And that would be something we call barter. Barter was done before any tribes or any cultures developed any sort of a currency or monetary system. Sorry, I have left my email open, so you might hear some dings. Sorry about that. Barter is simply trading what you had for what I had. The complicated thing about barter, and the reason it really doesn't work today in the way that it used to, not that people don't barter, people do barter, is that barter requires something, and this is important, this is an important detail and will surely be a question on an exam, is that barter requires something that's called a double coincidence of wants. Double coincidence of wants means you have to want what I have, and I have to want what you have in order for us to barter. What if I want what you have, but you don't want what I have? Then bartering doesn't work. Now, bartering did work a long time ago because there really wasn't that many goods available. And chances are, I wanted what you had and you wanted what I had. But this double coincidence of wants is an important piece of the barter equation. Barter can't exist without it. We have to want what the other person has to offer, or it just doesn't work. Let's talk about the earliest forms of money. So the earliest forms of money were really anything. They could have been seashells, they could have been rocks or minerals, or could have been pieces of gold. They could have literally been anything. But it had to be something that all of the people in the society would have accepted in exchange for goods and services. So money being something that could then be used in the case that there wasn't a double coincidence of wants. I wanted something that you had, but you didn't want something that I had. I could use that money and exchange it for whatever it is you had that I wanted, because there wasn't a barter situation available. It just had to be something that was generally accepted in that community, in that culture, in that economy. Literally could have been anything, okay? Money in its purest form is something we call a medium of exchange. Really, money is anything that just helps us facilitate that trade. But it has to be widely accepted. If it's not widely accepted, it doesn't work as a medium of exchange. But in the beginning of time, this really could have been just about anything, as long as it was valued and standardized and other people would accept it. A lot of money, the first forms of money, were something that we call commodity money. Commodity money is essentially a good that we could have traded as money, but we could also use it if we wanted to. So for example, our first coins were actually commodity money because they were made of precious metal. They were made of gold, they were made of silver. You could use them as money, as a medium of exchange, but you could also melt it down and use it for jewelry or whatever other purpose you may have wanted to. So commodity money is something that you could use for yourself if you wanted to, but you could also use it as a form of exchange for other things. Commodity money is still used in a lot of places in the world. There are a lot of tribes, especially tribes that only trade amongst themselves, that would still use something like commodity money, something that they could use if they wanted to, but also is a good thing to use to trade with. Funny story. This is a funner story to tell when I'm in person with you, but well, maybe it's not a funny story. So I'll make it quick. So I had a high school friend that I sort of lost track of after we graduated from high school. Decided I would go look for her, probably like 5, 6, 7 years ago. And so started just browsing the web, like trying to see if I could figure out where she was. And after weeks and weeks and weeks of trying to figure out where she was, I knew she was down in Phoenix someplace, but that's really as far as I got. I just did like a Google image search with her name in it and pulled up images. Sure enough, like the first image is a picture of her in an orange jumpsuit that said Arizona Department of Corrections on the front. So she was in prison. Anyway, decided I was still going to reach out to her. I figured out what prison she was in down in Phoenix, and I wrote to her. And she invited me to come visit her. Never been in a prison before. It was a total trip. But anyway, before I went to the prison, of course, with my economics hat on, yeah, I haven't seen her in 20, 25 years, but I started thinking about the economics in our prison system and what that looks like. And really, through that, I discovered that the economy inside prisons is really run on commodity money. That up until recently, those would have been cigarettes until they were banned in prisons. But it could be anything. It could be anything that prisoners had access to that they could buy at their little store, their little commissary. But they use commodities as money for exchange for goods and services. So a prisoner goes to the commissary, buys, they could be canned goods, it could be chapstick, it could really be anything, socks. And those could be used as money, just depended on what the most valuable thing was at the time in a prison. So commodity money is still a thing. It's not really a thing for us. So kind of continuing on the earliest money discussion, money has to have some important attributes. It has to be a medium of exchange, which means that you and I both have to accept it to facilitate exchange. It also has to be what we call a unit of account. Now, a unit of account, it's kind of hard to explain, but it's a unit of measurement that we can then value all other goods by. So the thing with exchange is because we use the dollar bill as our unit of account, we value things that way. That thing is worth $30. That thing is worth $10. It's that common unit that we can measure the value of other things by. Another important attribute of money is you have to be able to use it as a common unit of measure to weigh the value of one thing against the value of another. So even if you and I were going to trade, even if you had something and I had something and we did have that double coincidence of wants, we would probably use the dollar to decide how many of your goods were exchanged for X number of units of my goods. Like maybe mine is more valuable in terms of dollars. And so I get 2 of yours for every 1 of mine that you get. It just becomes this way that we measure the value of all goods. The other thing that's important about money and the earliest forms of money, it's still true today, is that it has to be able to store value. The dollar does store value. Yeah, we have inflation and a dollar is worth less tomorrow than it is today. That is true. But you could still gather up those dollars to do things like put a down payment on a house or pay your college tuition. You can save it up to buy something bigger. If money is something that is like produce, that's not a good store of value, right? Because you can't store up produce and exchange it for something else because it doesn't retain its value over time. So the money that we have is a good store of value and has money. That's always been a requirement of money. That's why things like seashells have always been a form of money, beads, and precious metals, because it's something you can gather up to buy something bigger with. Any questions? Okay. This is pretty easy. It's a lot of definitions. So here's just a little diagram of all of the things that would have been important, not only for early money, but for current money as well. We've sort of come full circle on this money thing, but if you can imagine, different things have been money over time, but these have always been 6 pretty important things. Number 1, it has to be durable. So it needs to be something that you can put in your pocket and take back out and, 100 times and it still is in one piece, right? It has to be portable. So portable means lightweight. It means, again, you can put it in a small bag or you can put it in a pocket or something like that to carry it with you. Things that are heavy or cumbersome obviously are not going to be good in terms of portability, being able to put it on your wagon or in our case, in our car and take it with us. Being divisible. It has to be something that you can divide into smaller units if you needed to. So you can see that the bad example on the chart says cattle. Like, I mean, yeah, eventually you can hack a cow up into some pieces and trade it off for a bunch of different things, but it's a pretty, pretty inconvenient thing to use as money if you're, hauling around this carcass, chopping off pieces. It doesn't make sense, right? And so things that can be divided up into smaller denominations, that's pretty important. Uniform in terms of quality. So things that are commodities, if you will, things that are pretty standardized. So we'll talk about this here in a minute, but when you're using something as money, especially those who were sort of trying to develop those first forms of money, if you're using a good as money, you're going to save the best quality goods for yourself, and you're going to use the lower quality as your money for exchange. And if you think about that for a minute, you realize that then the money would begin to lose its value if everybody's trading away really their crap and keeping all the good stuff for themselves. You're really not doing what you intended to do in terms of trying to come up with some form of money or currency. There has to be a low opportunity cost. Opportunity cost, what is the next best thing you could have done with that, whatever it is, that good, that metal, whatever. Now is made out of very low quality metals. Sorry, something happened. Okay. Low quality metals or paper. What's the opportunity cost of using paper for money? That you can't use the paper for something else. For what? Doesn't matter. Paper's not valuable. right? We have enough of it. It's no big deal. A bad example, they put diamonds. It's a bad example. The opportunity cost of using diamonds as money doesn't make sense because then we're taking them off the market. We're making them less scarce, if you will, which isn't good for the diamond industry and would never work. And there has to be some sort of stable value. I already talked about this. I talked about this in terms of produce. People have to accept whatever that money is, and it has to be something that will maintain its value so that you could collect it, you could amass it. So when you went to spend that quote unquote money next week, it would still have essentially the same value as it did when you got it. We know that all of this turned into the currency that we have today, and that most societies have a very similar, most economies have a very similar style of money and currency, if you will. So this is Gresham's Law. This is what I alluded to. And this was one of the biggest problems with commodity money and things like that, is that many times there wasn't a consistent quality of these commodities. If wheat was the commodity, you'd trade away the wheat that had been harvested 3 weeks ago and you'd keep the wheat that was harvested yesterday, because that was the wheat you'd want to turn into bread and eat. And so Gresham's Law said that commodity money is sort of tricky because it's tricky to find that consistent quality, and that over time, if everybody's trading away the commodity money with the lower quality, that then we just end up with money nobody wants, and it just isn't a suitable medium of exchange, and it just doesn't work out really well. And that's why we've evolved into the system actually that we had today. And I don't know if you know this, this is kind of a piece of trivia. You know how some coins, I think the quarter and the dime, have those little ridges on the outside? It's because people, when those were still made of silver, people would shave off just minuscule shavings of those coins when they were made of silver, and just save the shavings. And the money would actually, those coins would actually not be worth their weight in silver anymore, because everyone began to just shave off the edges. And so they put those ridges on there so you could tell if the edge had been shaved, because, right, people have an incentive to shave off those tiny pieces of silver. All right, so now let's kind of switch gears. We talked about money and sort of how it came to be and what are important attributes of money. Let's talk about banking. Let's talk about the first banking really that we saw and how it came to be and why it's similar to the banking system that we have today. So goldsmiths were actually the first bankers, if you will. Goldsmith, that would be somebody like a blacksmith, right? They would work with gold, they would make things out of gold and sell them. The reason they were the first bankers in that they stored people's gold for them is because that was actually one of the most secure places in any town or village would have been the goldsmiths, because it would have been guarded 24/7 because there was gold there, right? And so the goldsmith would, for a small fee, begin to store gold for safekeeping for people. And people had physical stacks of gold at the goldsmith shop in some back room someplace. Now we have vaults, right, where we stack it. But the goldsmith would actually begin to help customers. If he had customers that both held gold with him, that had a transaction, he could actually receive instructions to switch gold from stack, X to stack Y in payment for cattle or land or lumber, whatever it was. He actually began to swap money between customers, if you will, by moving gold essentially from one of his customer stacks to another. And then These instructions would come to the goldsmith many times written on, parchment or leather or something like that, signed by the customer saying, please move, an ounce of gold from my stack to, Joe Blow's stack or whatever. And those were really the first checks that were ever written. I know we don't really do checks anymore, but that was really the start of moving money from customer to customer without them having to physically do that themselves, right? And it got to the point where these goldsmiths started to think about the fact that there was so much gold sitting in the back of their shop that they started to, sort of unbeknownst to other people and his customers who he was storing gold for, began to make short-term loans with this gold for a fee. So he would know somebody who wanted to borrow money for, a fee, for interest, if you will, and he would loan out other people's money, and then he would collect the interest. And this is really the beginning of what we call fractional reserve banking. This is very, very important, this concept of fractional reserve banking. What this is a concept that is used, that is still used today, and in a pretty shocking way, I think. Banks, current day banks, actually are required to keep 0% of your checkable deposits, your checking account. So your checking account says it has $500 in it or $1,000 in it or whatever. The bank actually isn't required to keep that money in there for you. Yeah, when you go, they'll give you money, but it just comes out of their slush fund, their working dollars. But if all of us showed up at the bank looking for our money, the bank technically doesn't have to keep any of our checking account dollars actually in the bank. Of your savings, it's about 2% that they're required to keep. That's crazy, right? And so this is going to become really important in the next chapter, especially. This is fractional reserve banking. It actually has created a house of cards, if you will, in our banking system, where the dollars that we're showing in our banking system actually don't exist. We'll get to that, okay? This is just an introduction to this. But fractional reserve banking means that legally, banks are only required to keep a very small percentage of the money that you deposit in the actual bank. Okay? All right. Any questions on fractional reserve banking? Okay, if we all went looking for our money all at once, there would be a problem, a big one. All right, we're just back to terminology, okay? So that when we get to the next couple of chapters what we're talking about, okay? So some of this, it just talks to the evolution of banking. Banknotes were really that, we used to have a banking system that was based on silver and gold. And your dollars at one point in time would allow you to walk into the bank and exchange, let's say, a $20 bill for $20 worth of silver. And you could do that. Your banknote, your currency, if you will, really represented the gold and silver that was at the bank. Now, it's not like that anymore, right? That we call that the gold standard, and it's not that way anymore. Banknotes are the same as representative money. Those are kind of the same thing. A representative money is a banknote. It's a form of a banknote that exchanges for a specific commodity. So again, it would have been for lack of a better term, a paper is what we know as currency, paper currency today. You used to be able to exchange it. Sometimes it was for a specific commodity. So gold, silver, whatever. The dollar bills that you and I are spending today, those physical dollars, are what we call fiat money. So you're sort of looking at an evolution here. Right now, the dollars that we spend are not representative money. That dollar doesn't represent any gold or silver. Instead, it's fiat. Fiat money is money that actually, if you took a $20 bill to the bank and you said, I'd like to exchange this for something else, right? What would they give you? 2 tens, right? It's not really worth anything in terms of a commodity. It's just a piece of paper, essentially. And the reason it's good, the reason you and I still exchange it and accept it for payment for wages and things like that, is because it's essentially backed by the US government, our faith in the US government, not the US government, our faith in the US government, that they will hold our dollars valuable, that they will do what they need to do to hold our exchange rates good, that they will try and not keep our inflation in check, all of that kind of stuff. The only reason you and I accept those dollars is because we have faith in the US government and the way that they deal with cash in our system. That's it. Money is legal tender, which means that whatever the money is in an economy is usually deemed to be what we call legal tender, which means that if you offer dollars in payment for any debt, really people have to accept it by law. Now, I don't know who's gonna call the cops over something like this, but to pay a debt, you should be able to use US dollars to repay any debt that you have. All right, so switching gears a little bit to talk about our financial institutions. So we've talked a lot about money, we've talked about fractional reserve system, how that has sort of evolved over time. And now let's talk a little bit about the different types of financial institutions that we have here in the US. Now, before I go through this list of these 4, many of our financial institutions today actually are all 4 in one. But these are sort of the 4 different functions of financial institutions, but I would say that your big banks, your Wells Fargo, things like that, those financial institutions are going to cover all 4 of these, but some banks don't. Smaller banks don't. So the first one is something we call a financial intermediary. Financial intermediary is really somebody, an institution that takes in money from people who have extra, who want a safe place to store it, who then take that money and turn it around because they don't need to keep it, right? It's a fractional reserve system, and turn it around and essentially make loans to people at a much higher interest rate. So people, you're not making any money when you put money in a bank. When you put money in a savings account or checking, you're not making any money. But the bank is taking your money, they're turning it around, they're loaning it to people, and they're making money. That's how banks make money, right? They act as depositories, which means they accept deposits. They accept your money. You can go and deposit it, and for the most part, it's pretty safe when you deposit it. There's also safety deposit boxes where you can put valuables and things like that if that's something that you have. Then we have commercial banks who essentially primarily deal with businesses, have business accounts, give loans out to businesses. They really deal in corporations, the commercial side of things. And then the 4th thing is thrift institutions who really do banking for the average person, households. You know, a lot of these are going to be, there's a lot of thrift institutions. There's a lot of banks, if you will, that don't have big commercial accounts, that don't really deal with businesses. Instead, they just deal primarily with households, with smaller savings and things like that. Credit unions are a good example. But like I said, Wells Fargo is going to be all 4 of these wrapped up into one. It's just the 4 different sort of aspects of financial institutions that you might see within an organization. All right, so let's talk a little bit about the Fed. The Fed, short for the Federal Reserve Bank. The Federal Reserve Bank is kind of the bank of the banks. This This is stuff you need to know, what's on this slide, and I'll talk you through a lot of it. We're going to talk extensively about the Fed because they're a really, really important player in this whole macroeconomic discussion. And we're going to build on that over the next week or so. So our Federal Reserve System started a long time ago, right? It's over 100 years old. This is essentially, we call it our central bank here in the United States. It has, there are 12 banks in our Federal Reserve System. The US is broke up into essentially 12 different areas, and these Federal Reserve banks sort of are the authority, if you will, that regulates banks, that makes sure that banks are complying with all sorts of laws and regulations and things like that. We in Arizona, so I don't know where you all are, but I know a lot of you are here, but in Arizona, our Federal Reserve Bank's in San Francisco. So they're not necessarily close, but it's the San Francisco Federal Reserve Bank that sort of monitors the banks here in Arizona. So again, there's 12 of those. What is the power of the Fed? Well, the Fed has a lot of power, okay? They issue banknotes, so they essentially can issue currency. They put currency into circulation. They don't print money, that's the Treasury, but they can essentially put new dollars into our system. And we'll talk about that. We'll talk about how they do that. They don't just like, money doesn't drop from the sky. That's not how you put money into a system, right? The second one is big. It's the thing that we're really, really, really going to talk about extensively, and that's the buying and selling of government securities. Government securities are the same as government bonds. That's the same as government debt. So when the government needs to borrow money, many times they'll call up the Federal Reserve Bank and say, we're looking for 2.2 trillion right now, right? So whatever it is. So they'll say, we need 2.2 trillion. And so the Fed will essentially sell this debt. And it's an investment for investors. You make, I don't know, it's not a great investment. I mean, it's a solid investment, but you're not going to get rich off government securities. They have a very low return. It's a few percent, but it helps your money keep up with inflation, if that makes sense. So a lot of people who are looking for safe investments will invest in government securities or as part of a portfolio, stocks and government bonds, government debt. The buying and selling of this debt is the Fed's job. And it's a really, really, really important tool when we talk about monetary policy. It basically is monetary policy, okay? They extend loans to bank members. So this means all of the banks that you and I use are essentially members of the Federal Reserve Bank system. They've all bought into it. And as a result, they are regulated, but they are also eligible for loans. So you know how they don't have to keep any of your money? What happens when we all go in looking for money? And the bank simply just doesn't have our money laying around because they're only required to keep that 2% of our savings. They can call up the Fed and they can borrow money from the Fed just overnight if they need to, or for a week or for a month or whatever. If they don't have the money that they need, they can call up the Fed. The Fed will loan them money for a fee, right? It's not free. It's also the Fed's job to decide what the bank reserves are required to be. So that 0%, 2%, those numbers I gave you when we talked about fractional reserve banking, was the Fed that decided that. It was the Fed that decided they didn't need to keep any of our checking and 2% of our savings. They can increase or decrease that percentage at will. Here's the thing. If you don't require banks to keep money in their vault, they can loan it out. And when banks loan out money, they loan it out to people who want to spend it, who want to go buy things with it. That's good for an economy. So that's the reason it's so low, is because it keeps that money cycling through an economy, which is different than you saving your money under your mattress, right? It's not cycling through the economy. And so anyway, the Fed has control over those percentages, those what we call required reserves. So what the bank is required to keep on reserve, it physically in the bank, okay? So let's talk about the objectives of the Fed. I think these should be similar objectives that I would have given you when we talked about the objectives of the federal government. They're a little different and a little bit more complicated, and this simply is their single job, is to get these things done, right? And so high levels of employment, the federal government's working on that too. Economic growth, federal government should be working on that too. Price stability, yep, that too. Here we're talking about inflation and deflation. So we're talking about sort of keeping inflation at that customary 2 to 3% rate that's normal and is right for our economy. But the Fed has these few other objectives here. So interest rate stability. So they're the ones essentially that set the interest rates, right? Financial market stability. We're talking about stocks. We're talking about bonds. We're talking about the loaning. We're talking about all of that financial market stuff. The Fed, right? When the stock market a few weeks ago, when the stock market was acting very unstable, right? They were really the first to dive in. And I said this probably the last week we were in class, when the Feds cut the rates. I said, oh shit, something's about to happen, right? They were the first on the scene because they knew, right? Those economists already saw what was happening and saw that we were going to have, pretty unstable financial market conditions and wanted to try and create some stability. Now, they may have created some short-term stability through those interest rate cuts. And exchange rate stability. So that has to do with the dollar up against other currencies in the world. So just trying to keep our exchange rate good for Americans, for American-made goods, things like that. Any questions so far? Pretty good. It's a lot of terminology and stuff. Okay, but it's important stuff. All right, so let's talk a little bit, just because it's relevant. We need to talk a little bit about the recession, the 2007 to 2009 recession, because the Fed kind of screwed this up. They kind of, I don't want to say it's their fault we had the recession, but it was through some negligence, perhaps. The Fed is also the one who probably better than anybody was able to get us out of that recession. So let's talk a little bit about the catalyst behind that recession. That was something we call subprime mortgages. These mortgages were mortgages that were given to people who didn't have very good credit. Many times these mortgages for these homes were at very high interest rates. Why? Because there's a huge risk involved when you loan hundreds of thousands of dollars to somebody who doesn't have good credit. As a result, people's mortgage payments were mostly interest, which means they weren't really paying down any of the principal or the actual price of the house. It became really easy for people to get mortgages, and it turned people that should have stayed renters into people who now owned homes, who perhaps didn't understand the other expenses that come with home ownership. So not only did they have these huge mortgages in which they were paying mostly interest, but then there were all these other expenses on top of it. And what happened, because there were now all of these people in the home market that perhaps wouldn't have been eligible before. It drove up the demand for houses. When you drive up the demand for something, right, it drives up prices. And so housing prices, we saw housing prices go up. And what ended up happening is eventually, after a year or two or three of these subprime mortgage practices, people simply couldn't keep making those payments on those houses that they really couldn't have afforded to begin with. And then that's where we saw the housing market really take that huge dive. And people had invested in these mortgages. Mortgages are bought and sold like any other investment. And because you earn interest. So there were a lot of what we call mortgage-backed securities being sold at that time. Yeah, they were risky, but investors were making a lot of money off these mortgage-backed securities. Well, when the housing market crashed, it took housing prices with it, it took people's credit with it, and it took these mortgage-backed securities with it. The reason these subprime mortgages were being given out is because mortgage lenders, physical people, if that was your job was to approve people for mortgages. People were receiving incentives, like physical dollars, for every mortgage they approved. Well, if you're getting paid for every mortgage you approve, you're going to approve every mortgage you can, right? You're going to try and get everybody you know in a house. So it was that oversight of that mortgage lending system that maybe the Fed should have been a little bit more proactive in. We'll talk more about this here in another couple chapters when we talk about how the Fed's tried to get us out of this mess, that recession. But anyway, we needed to give you a little bit of intro to the mortgages that are going to end up taking us into a recession, which we're going to talk a lot about when we talk about monetary policy. Okay, so here we are. Here's our financial crisis of 2008. Your author picked 2008. It's a range of years that is up for debate, but we all know what we're talking about here. Mortgage brokers had incentives to approve risky loans for high brokerage fees. Those brokerage fees are their incentives. You approve a loan, you get it pushed through. You get $1,500 for every mortgage you push through. Well, of course, you're going to push through as many as you can, right? Size of mortgages, usually in typical times, people have to save up money so they have down payments on a house. So they're not financing the entire house. Well, during that time, for whatever reason, mortgage brokers started loaning people 100% of the property's value. So that's, sorry, my home phone's ringing. 100% of a property's value, which means that if a property went down in value at all, the amount of money that had been borrowed to purchase that house was now more than the house was worth. So when this whole thing started to crash, people owed more on these houses than they were worth and started moving out and foreclosing and walking away and things like that, right? People had no incentive to keep making payments on a house that was worth less than the amount they owed on it. And in many times, hundreds of thousands of dollars less, right? And it then took these mortgage-backed securities with it. And a lot of investors lost a lot of investors made a lot of money, but a lot of investors lost a lot of money too on those mortgage-backed securities. So, oops, sorry. Okay, so a couple of things happened as a result of this subprime mortgage lending problem. The first is, and we won't talk too much about this, is something we call TARP. And the Treasury, the US Treasury, actually bought a lot of these mortgage-backed securities. They were a bad investment. That was essentially worth a fraction of what people bought them for. The problem is that so many lending institutions, so many big investment firms had these mortgage-backed securities as part of their assets that essentially Had the Treasury not come in and bought some of these investments, these mortgage-backed securities, we would have seen a total collapse of the banking system as you know it today. We still had a lot of banks go out of business, and a lot of small banks, right? Because it only took a few bad mortgages to essentially take down a small bank. We do, as a result, have the Dodd-Frank Wall Street Reform and Consumer Protection Act. This is basically the new rules we got after this all happened. It says you no longer can give mortgage brokers incentives to produce loans in that way. That's not good practice. We all know it's not good practice, but it wasn't ever written anywhere, and now it's written in this protection. Oh my gosh, is that it? All right.